Good evening. My name is William Hager, and this is my assumptions and pro forma financial statements for my firm, Lean Fan Drives. In this Excel sheet, I have assumptions, sources and uses, income statement, and balance sheet that I'm going to give a brief overview of with you tonight. Starting off, Lean Fan Drives is a local manufacturing company that manufactures and sells fan drives to the big three automobile producers, which are Chrysler, Ford, and GM. The company adapts to the latest technology and equipment on the market. A unique aspect of the company is that it utilizes current lean manufacturing techniques in its everyday operations. If we look down here under G and equipment, the most recent capital spending on the new machinery cost $5 million. The company updates our capital equipment every 3 years due to the wear and tear of the machines and upcoming advanced technology. The company produces 110,000 units per month on average globally. If we look down here at section H, our company has a tax rate of 30% and an excellent interest rate on cash from Bank of America. If we come up here to section D, labor per unit cost is $8.75 and cost per material unit is $8.50. If we come down here to F, warranty costs $12,000 per month and scrap costs $10,000 per month. If we take a look at operation expenses include direct labor, indirect labor, repairs and maintenance, freight, travel, perishable tools, outside services, training, and utilities, and this costs the company $1 million a month. So since this is a bigger company than many of my classmates would have come up with, we had an initial cash balance of $35 million. So this would mean that we need a substantial amount of angel investors to get this kind of amount. Product sales, you can see in month 1. The company is selling well over the last 24 months, and its products are seasonal due to the nature of the automotive business. So August is when the new model year starts, and more sales around the summer, and they drop a bit over the winter. During the holiday month of December, the plant shuts down for a week, so the company loses approximately 25% of sales. And you can see right here, it's a steady increase, and then once you get to month 12, it decreases, and then in year 2, once you get to month 24, it also decreases. And hence, you see a negative impact on net operating income, which is shown in red. In the second year, month 24, we had an expedited order from overseas from the GM plant in Mexico. Therefore, the units sold were approximately 30% higher than the same month of the previous year. And in the last 24 months, our PPM has always been under 200, so there was never a change in scrap and warranty expense. Warranty expense and scrap expense are fixed costs as they are a special contract with the big three automobile producers. As long as the ppm, which stands for parts per million, is below 200, we will be paying the OEMs, original equipment manufacturers, a warranty and a fixed warranty and scrap cost. And if we take a look back at G, the $5 million for the cost of equipment over the 3-year straight line depreciation, you can see month by month the change in value. So now if we take a look at the sources and uses tab, we have our initial cash balance of $35 million with an interest rate on cash of 3% annual. As you follow the months, they increase slightly each month. And then again, we have in section D, direct cost of materials, labor, and your fixed cost of your operation expense, your warranty, your scrap, and in this case, we have no taxes. If we take a look at our income statement, net sales for month 1 slightly increases over each month. And here again you can see the change in materials and labor. And then our gross margin for month 1, it does fluctuate over the year. And the same can be seen for months 13 through 24. And at the bottom of each month, we see the net income. So the net income fluctuates throughout the year. During the summer months, our net income is the highest, and at the end of the year, it tails off slightly. And the same can be said for year 2. So you see our highest net incomes are during the summer months, and they tail off during the winter months. And lastly, if we look at our balance sheet, we have cash for year 1 at $30,561. We have receivables slightly over $3 million, and we have inventory slightly over $6 million, with total current assets equaling $9.5 million. We have our fixed assets of $5 million, depreciated of $500,000, and our net fixed assets of $4.5 million. So year 1 total assets equal $14,017,423. And if we look at year 2, we have cash of $105,718. We have receivables of slightly over $3 million and inventory of nearly $7 million. So our total current assets for year 2 is $10.5 million, with fixed assets again of $5 million, less accumulated depreciation of $1 million, and our net fixed assets for year 2 equaling $4 million. So again, total assets for year 1, $14,017,423, and year 2 is $14,507,569. So now we're going to take a look at liabilities and stockholders' equity for year 1. So accounts payable materials, $1,088,000, accrued salaries of $12,000, which gives us a total current liability of $1,100,000. We have paid in capital of $30 million and retained earnings of a negative $22 million, gives us a total equity of $12,917,423. If we look at year 2, Accounts payable material is $1,020,000. Accrued salaries is $12,000. And total current liabilities equal $1,032,000. So again, paid in capital of $35 million, retained earnings of a negative $21.5 million, give us a total equity of $13,475,569. So the most important thing here is that in year one, total assets equal total liability and stockholders' equity. And in year two, total assets equal total liability and stockholders' equity. So if we take a look back at the assumptions tab, this $5 million for equipment, that includes CNC mills, CNC lathes, manual mills, manual lathes, shot peen machines, wet blast, grinders. So there is quite a bit of equipment that go into a manufacturing facility this size. And once again, most machinery, once every 3 years, we like to replace it, get the latest and the greatest so that we can compete with our other competitors. I know this was a quick and brief overview of the 4 tabs, but I hope it gives you a slight indication of what a mock business would look like of this size. Being new to the ME program, I do not have an actual business that I own, so I was instructed to come up with a business of my own that I was interested in. I've grown up in the manufacturing world, so this was, I think this really tied in nicely to my experience in GE Aviation and really gives you an in-depth perspective of what it takes to make a business of this size succeed. I had a couple of quality engineers, I had one operations manager, and I also had my father take a look at this, who ran GE Aviation for 35 years. They are all familiar with what it takes to run it as far as direct cost, product sales, inventory, all the big labels that you see on the left side. I am by no means an accounting expert, but I am happy with the results, and I know it probably can be tweaked a little bit more. But for for a first shot at this in the ME program, I am very successful. I'm very happy with the outcome. So I just wanted to thank the rest of my classmates as well as both of my professors for giving me the opportunity to take a look at something like this. I've never really dived into a project of this magnitude, and a lot does go into making a business work. As we've learned, you have to have angel investors on your side, and they have to understand the business that you are going into. Any support from them will be of great assistance in the future. And yet again, these numbers are a trial. This is a mock organization. And thank you all for your time.